Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. I'd like to welcome Mr. Simon Caufield. I've known Simon for almost a decade since he came to the first Cyprus Value Investor Conference. Is an amazing person. He owned a software business, which he sold, and he became a full-time investor. Having that entrepreneurial background has made him a very smart investor. He's presented some amazing ideas in Cyprus, bar one, I think.
Well, let's not talk about that one. Yes.
Talk about that one. But we will be discussing with him today IWG, or what do you call that? WeWork?
It's International Workplace Group, and of course, the most important thing to know about it is that it's not WeWork. And no doubt we'll get into that.
Oh, thank you very much, Simon, for coming. I always learn a lot through our discussions.
Thank you for inviting me. And let me say right up front that to the listeners, if you don't go to the Value Investor Conference in Cyprus, then you're really missing out. This is the best event of the year. Great people, great location, great ideas. And as the Irish would say, the crack is great too.
So IWG, what does the company do?
So people might remember it as Regis. It was founded in 1989 by a British entrepreneur who left school at 15. He founded it when he was 30 years old. And it was called Regis at the time. It didn't change its name to IWG until 2016. But it is, by a long way, the market leader in the worldwide, very fragmented marketplace for flexible office space. So yes, it's in the same industry as WeWork, but it has a lot of differences to WeWork, and we might get into that. The reason to be interested in it is that I think at the current share price, it might be worth 5 times. In Cyprus, it was worth 4 times. Now it might be worth 5 times the current share price. So things are really going in the right direction. But it is a little complicated. There is quite a lot to get your head around.
You said the founder who left school at 15, this is Mark Dixon.
That's right. Well, he's like many entrepreneurs who leave school early. He was trading at school. He started a few businesses after he left school. If you Google him, you will no doubt find out that he is known for being a former hot dog salesman. This may tell you something about one of the at least dozen reasons why this stock is hated and cheap, is that by and large the market tends to regard Mark as a little bit unsophisticated, shall we say? And you can imagine that he might be difficult to work for, but he's created this business from scratch. If I'm right, it's worth $10 billion, and he owns 25% of the stock. So I think you want to be careful before you're too critical of Mr. Mark Dixon.
So he doesn't come from money.
No.
He started off in various businesses, and he developed this Regis business. That's extraordinary. Are there any books written on this man?
No, actually, I don't think so.
It's something you'd expect. I mean, from this level of success, I'd say.
Yeah.
So there's different segments that we have to understand. Is that right?
Yeah, that's right. There are essentially 3 businesses. There is what we might call the legacy business. There is a capital light franchise version, and they're transitioning from the legacy business to the capital light business. And then almost hidden away there's a software business called Worker, which is kind of like an Airbnb for booking flexible commercial office space. And in 2022, the private equity firm CVC Partners offered IWG £1.5 billion for this business called Worker, which IWG turned down. £1.5 billion is basically today's market cap. So unless this business has become less valuable, and I don't think that's the case, then the Worker business is worth the entire market cap of the company.
When they did that 1.5 billion division, was there any more color? Do you know, besides the public statements? It wasn't developed within IWG. Wasn't that
Yeah.
bought?
So, actually, in 2022, they bought a business called the Instant Group for about 300 million sterling. And they combined it with their own fledgling businesses in-house. They had two software-related businesses in-house. One which was doing a similar thing, which is the Airbnb for booking commercial office space, not just confined to IWG properties, but the entire marketplace. The business was called the Instant Group. And then they had another business in there, which is a software business to help customers manage virtual offices. So communications and IT and all that kind of stuff. So they put the two together, and actually the bid from CVC came in the same year for 1.5 billion.
It's a 5x in 1 year, doing nothing.
Extraordinary, isn't it? I think maybe they should have done, but they took the view that this was a fast-growing business, and that they would be able to grow it for 3 to 5 years and then sell it at a higher price. And I'm convinced they will sell it, because I think the market won't recognize the full value of IWG until these three businesses are separate.
So are the Worker people still involved, or have they exited?
Yes.
They're still involved.
Yeah.
Okay.
And they still have a minority stake, a very small stake, yeah.
Okay. You go back and you see there's a 2.5 billion bid from Brookfield. Some talks about a 4 billion deal from CC Capital in 2021.
Yeah.
So there are all these different deals. I saw something on the internet that Mark Dixon was looking to sell, but directors blocked this. He has 25% stake, but he wasn't able to do the deal. And I'm just wondering about this.
I mean, and there have been rumors about bids for quite a long time. One thing I wanted to add about the 2021 bid from CC Capital, it's not a name that I know terribly well, but 4 billion would have been about £3.70 a share. Today it's £1.50. And of course, in 2021, if you can think back that far, nobody was terribly interested in anything to do with office. So I might argue that the same bid today might be more than 4 billion, but that's pure speculation. In terms of why have they never done any of these deals? I think, Mark Dixon is 65. It has been rumored for quite some time that he wanted out. But I think it's the case that most of these deals have been potentially struck at a price that Mark Dixon thought undervalued the company. And it being his life's work, he was reluctant to sell at less than what he thought fair value. That being said, at least one of the deals, potential deals, and I can't quite remember which one, the market speculation was that the board turned it down rather than Mark Dixon. But I don't know any more than anybody else on that. Yeah, I do. I do kind of believe the stories that he wanted out because for some years it's known that he's developed some interests outside IWG, particularly wine, particularly rosé wine. Would you believe? And he's bought some vineyards. But you can imagine, as a very proud man, having started this company, still owning 25%. I think he's reluctant to let it go at less than fair value, or much closer to fair value.
Yeah, having said that, Mark Dixon in May 24 sold 35 million shares at 196.
That's true, of course. I don't know any more than anybody else on that. The RNS statement that the company issued at the time said that he was doing it because he basically had a bank loan to pay off. I assume, but again, I don't know, that bank loan was associated with the purchase of one of his vineyards. But I don't know. And the other thing that I would say is that, and on the day this happened, the share price fell 10%. So presumably the market didn't like the fact that he was selling. He used to own 29%, and he sold about 4%, raised about £70 million. He still owns 25%. But people quickly forget that in 2020, he invested 97 million pounds of his own money, 90 million pounds of which was in a capital raise. They, at the peak of the lockdowns, when the business, of course, was suffering badly, IWG did a capital raise of about 300 million, and he put in 90 million of his own money at that time. That was, by the way, that was done at a price of about £2.90. In 2019, IWG adopted IFRS 16 lease accounting. And this has made the comparison of financials pre and post 2019 very difficult.
If you pull these up on something like Capital IQ, you'll see consensus, for example, EBITDA is 1.5 billion for 24 versus 0.5 billion for 23. And you're like, wait, they're growing they're tripling their EBITDA, and you're like, no, that's because the consensus has, that's with the leases in there. That's not the underlying business itself, and then so depending if you want to do it with the leases or if you want to do it without the leases, it's so it's one big mess. So
it is. I mean, it seems to me that the adoption of this lease accounting has arguably made the balance sheet more representative of the business because it does recognize that
yes,
you have a long-term commitment. Previously, it just used to be reported in the footnotes, and it wasn't the lease liability wasn't included on the balance sheet. But it's made the income statement less indicative of the business because it has replaced what used to be a very real lease expense, the rent that you paid to the landlord. It's replaced it with two expenses: the depreciation of the right to use lease asset and a notional interest charge on the lease liability, both of which are fictitious. So the income statement, the balance sheet might be more representative. The income statement is much less representative of the entire business. So this is another reason why this stock is difficult. But
it's an extra exercise. At the end of the day, you can value it with the leases or without the leases. It doesn't make much difference if you're doing it properly on the multiple itself.
Sure.
Do they still have separate digital brands, or is everything falling under Workup?
I think everything is forming under Worker. One of the things that they have done with this business is that they've gone for a major software upgrade, and they've essentially frozen the client base whilst they go through this software upgrade. So the Worker business hasn't grown for 18 months, and they're a bit late on this software upgrade. But hopefully it will return to growth. I assume that they will then consolidate all of the brands at that point.
So okay, so everything's under Workup. So we have the digital business Workup, and now we also have the the company, the owned and leased. How does that
That's
work?
right.
Is that
So this is how the company started. It's still by far the largest business, and this is the business that everybody thinks of as being an unattractive business. Capital intensive, cyclical, asset liability mismatch. So no barriers to entry, so on and so forth. So let's talk about it a little bit. So in this business, the flexible office provider will take out a very large, long lease from a building owner, and in the UK, for example, only about 15% of the business is in the UK. 40% is in 45% is in the Americas, mostly US and Canada, and 35% I think is in Europe, and there's about 10% in Asia. But in the UK, at least, when you take out one of these leases from a owner of an office building, it's very long term, it's very inflexible. You have typically upward only rent reviews every 5 years, and they're very unattractive. But if you want to be, historically at least, if you wanted to be in the flexible office space, you took out these long leases. You converted the building from a conventional office to a flexible office. That too is more capex. And then you leased it, but by and large, to small companies and startup companies on relatively short duration agreements. The reason, of course, is that the advantages of flexible office are most pronounced for small businesses and startup. You can quickly adjust how much space you've got without the inflexibility of a very long, inflexible traditional lease. In addition, when you're starting out, and I know this because we started our business in a Regus office in the UK, our software business, goodness me, 25 years ago. You also get a certain amount of kind of office services provided by the flexible office provider, which are quite advantageous when you're starting out. Things like IT, and in those days, telephony was the telephones was an issue. Reception and secretarial services, you could pay separately for office space, for a meeting room space only when you needed it. So quite an advantage for small businesses and startups. And that's why the traditional business historically has been mostly for small companies. But you have, as I said, a lot of capex. You have the lease liability and you have the capex for conversion. You have a big asset liability mismatch because you're borrowing long and lending short, the opposite of what banks do. And people are worried about that. And indeed, these businesses have had difficulties in recessions. Indeed, the US business of what was then Regus went bankrupt, Chapter 11 bankrupt in 2003 because a lot of its clients were dot-com companies that, funny enough, stopped paying the rent. They bought it back. Incidentally, this is typical Mark Dixon. They bought it back out of bankruptcy, reducing the debt and the like. And they also at that stage hit on a brilliant idea, I think, which is something that WeWork didn't do, is that they started putting all of their buildings into special purpose vehicles. So the leases, whilst they're consolidated on the IWG balance sheet, they belong to special purpose vehicles, so that if IWG were to default on one particular lease, there's no recourse to the rest of the company. And this has allowed them to abandon buildings or to more commonly renegotiate rent agreements in a downturn. But none of that was in place in 2003. So the US business declared Chapter 11 and then was bought out. So there are no barriers to entry in this business. Anybody can, take out one of these leases, pay to convert it to a flexible space and start in the business.
Yeah, when they take out the lease, is that like a fixed rate, or does that get adjusted?
The lease liability historically has been a fixed payment for 5 years with upwards only rent reviews. So now, by the way, things have moved on, and these days we think this is not disclosed, but we think that IWG now has 40% of its leases where the lease payment that it makes is related to the revenue that the landlord generates. So much more flexible. So those are all the reasons why people think of this business as not to put too fine a point on it, crappy. But and IWG is very definitely in that business. I'm not trying to disguise that fact. But there are a couple of aspects of its business in this space which are a whole lot better than that. First of all, this is a marketplace that is growing, and I think in the general disgust that people feel for office real estate these days, you shouldn't forget that the flexible office space market is growing. Indeed, there was a report issued, I think, in late 2022 by Savills, a commercial real estate broker in the UK, in which they said that the flexible office space had grown to become 15% of all office space in the UK. So this is a growing market, but that's in the traditional business, that's almost the only thing it's got going for it. Everything else is rubbish. But IWG has these two aspects to its business, which are much better than that. The first is that it serves large corporations. Now, what's different about large corporations are somewhat attracted to this because, well, they're increasingly aware that they don't want to have a large inflexible lease on their balance sheet. They are too not sure about the long-term future of the traditional office. It's fixed cost, and arguably managing office space is very far from being a core competence for many of these large businesses. So in recent years, there has been growth in large corporates wanting to use flexible office space. And these deals are very often, they cover more than one office. They might be regional, they might be national, they might be multinational. IWG even has some global agreements. Today, it says that 83% of the Fortune 500 are customers of IWG. That's, I think, very, very different from the traditional market for flexible office space. And the thing about this segment is that almost nobody else can do this because IWG's network is 6.4 times the size of the next biggest competitor, which is WeWork. There are then a couple of players sort of half the size of WeWork, one of which is called Industrious, one of which is called Servcorp, listed in Australia. But they're smaller again. So at this current time, it's almost impossible for any competition to do deals with large corporates where you're talking about a multi-office or a multinational deal. And so therefore, whilst there are no barriers to entry in this market, in this particular segment, there are barriers to scale. Post the pandemic lockdowns, we've talked a lot about office versus work from home. And I get the sense that in the last year or so, there has been a bit of a swing back towards work in the office, because I think most people recognize, not for all types of job, but for many types of job, you're much more productive when you're in the office. You know, you're part of a team. You can interact and work with the team. You've got better office infrastructure, IT, and all those kinds of things. And so,
no crying children in the background.
Yeah, that's right. For all kinds of reasons. But some employees have gotten pretty attached to working from home, and IWG's work close to home offering is a bit of a compromise. You sort of get all of the productivity benefits you can, that you would have in the main head office, traditional head office. But the commute times are much less because you're working close to home. And again, nobody else can do this business because more than 50% of IWG's network, which is 6.4 times WeWork in terms of scale, more than 50% of its network is suburban. WeWork in particular, when it started, it tended to concentrate on, high-profile, prestigious buildings in the centers, in the main business districts. But IWG has always had a big proportion of its network in the suburbs. So these two aspects of the traditional business are significantly more attractive than the typical traditional small company, startup focused, flexible office marketplace. It's a very, very fragmented market. Most of the buildings owned in this space are owned by people who only own one building or perhaps two. If you want to use several offices, you're a traveling salesperson or project manager or something, and you travel a lot. The beauty of going to IWG is that you have the same IT infrastructure wherever you go. So that's it's not a huge thing, but it's a useful advantage. And then if you're a large corporate and you want to be able to provide those types of services for a large number of employees over a large geographic area, then you really don't have much choice but to go with IWG, except in very special circumstances where somebody else just has happened to have the buildings in the right place for you. But that's not going to happen when IWG's network is so big.
You can definitely see savings from their size, because if you're IWG, you can have one IT guy sitting anywhere in the world and servicing.
Yeah. IWG does all of its client billing out of the Philippines, right? That's scale advantage. That's a cost advantage. Is it a ginormous advantage? No, but it's a useful advantage. So,
it all adds up, right?
So the IWG business in traditional is usefully better than for everybody else. Maybe something else that's worth saying is that for IWG, ancillary revenues, these are the revenues that are not rent related, amount to about 25% of total revenues. So they are, for example, probably the world's largest buyer of tea and coffee. And they generate, I think I saw they generate £60 million a year from tea and coffee. They benefit from car parking fees. They benefit from separate payments for IT infrastructure, and so on and so forth. So again, these are things that are difficult for the mom and pop stores to do for themselves.
So is the coffee not free?
Oh, it may well be free to the people using the office, but it's not free to the for the company leasing the space.
Okay, because that's what I was thinking. I was like, I guess if you're a single entrepreneur, you're also paying for that.
Yeah. I think it's the case that uh, the menu, so to speak, at IWG has more than 100 items on it.
Oh, wow.
So they are extremely good at generating revenue from ancillary services, many of which you. That's right. It's the kind of traditional. The headline price might look attractive, but there are lots of ancillary add-ons. Before we leave the traditional business, it is worth saying that in 2021, CB Richard Ellis, the commercial real estate broker, took a 40% stake in the number 3 competitor called Industrious. Now Industrious is an old-fashioned style of flexible office provider. It has no equivalent of Worker, to the best of my knowledge, and it has no capital light business, which is the business that we haven't spoken about yet at IWG. Its network is less than 10% the scale of IWG. And if you just pro rata the price that they paid for their 40% stake, you get to £6 a share. £6 a share for the traditional business alone. And again, this was done in 2021, if I remember rightly.
What was the name of the
guy? Just check here.
What was the name of the person?
Yeah, February 2021. CB Richard Ellis acquired. He did it in 2 transactions, but they paid $330 million for 40% of Industrious, which has less than 10% the scale of IWG. It has no Worker equivalent. It has no capital light business. And so if you just scale that up, you get to £6 a share, which is four times the current share price. And once again, in February 21, I don't remember people being terribly excited about office real estate. So maybe if they were to do it today, it would cost more.
CBRE acquired its 35% ownership in the form of primary secondary shares. The consideration includes approximately $200 million in cash and the transfer of HANA.
Yeah.
HANA is a flexible
HANA
solutions.
Was their flexible space business.
Okay, so there was some value to HANA and the $200 million cash. But even if you just took the $200 million cash times,
you multiply it by 10 because of the scale, and then you've got to multiply it by 2.5 because they only acquired 40%.
Yeah.
So you're multiplying it by 25 times. So that gets you to $5 billion. Let's say £4 billion. There are about 1 billion shares conveniently. So that's about £4 a share.
Yeah.
Even if you just take the cash element. Yep.
They're probably thinking.
And as I say, February 21, I think we were locked down in February 21, weren't we? Yeah, I'm pretty sure we were in the UK at least.
Okay. And so we have the conventional business, the Worka, we talked about digital, and now we have this big new thing, the franchised and managed.
Yes, that's right. So this is the third leg, and in some ways is the most exciting. A number of shareholders had lobbied IWG for quite a few years to switch to a capital light business model. And Mark Dixon had resisted. But I think he got so fed up with the share price being so much lower than his estimate of intrinsic value that in 2019 he got religion. And they announced their intention to convert, to transition to a capital light business. And the first thing that they did was to sell and franchise their entire Japanese business. And they did it for a one-off cash lump sum equivalent to 3.4 times the revenue of its Japanese business, plus a franchise fee, which wasn't disclosed but was thought to be between 4 and 5% per annum. Now, it was bought by a Japanese real estate operator who I think sold it on. They sold it on at a small loss, but a relatively small loss, given that probably interest rates had gone up. Well, maybe not in Japan. But again, this gives you some way of putting a value on the conventional business. So in my Cyprus presentation, you may remember that I didn't use 3.4, I used 2.5. But if you use 2.5 on the remaining conventional revenue in the business, you again get to £6 a share. So,
I mean, first half 24 revenue of the conventional business, 1.6 billion. Right? Is that right? What I see here?
Is that dollars? Maybe.
Sorry. Sorry. $1.6.
Yeah, they changed from sterling reporting to dollar reporting starting in 2024. So that's another. Watch out for that one.
Yeah, I don't like that they did that. This whole it's so gimmicky. We're gonna switch from pounds to dollars, confuse everyone. Then they also said they're going to shift to U.S. GAAP.
That's right. U.S. GAAP, as I understand, I'm not an expert in comparing accounting systems, but I understand U.S. GAAP is slightly friendlier towards leases. But of course, everybody is speculating that this may be just a prelude towards listing in the U.S. And given that 40% of the business is in the Americas time zone, there is some logic there.
So I don't think, changing accounting is going to, or changing currency is just going to fool any professional investor who's going to spend the time to understand this stuff.
I'm assuming that they're doing this because of the possibility of a US listing.
Yeah.
The advantages are not big enough to do it for any other reason, I don't think.
I'm not such a big fan, to be honest, of this whole theoretical geographical arbitrage, because I don't think necessarily companies, you see some companies that do well, but that's because they were great companies initially. So it's not like, you were a crap company and you went to the US and all of a sudden you're a darling.
I think there are some examples of where companies have been revalued by moving to the States, and there are others where it hasn't made a difference. I've not studied for the reason for the difference.
I mean, you could even look. I mean, a good way to look at this is just look at consumer staples, right? You look at consumer staples in the U.S. and Europe, and they're pretty similarly priced. Same thing probably with automobiles, if I'm not mistaken. You see some similarities. Similarities again with like developed, I think, banks. So there's also a lot of these examples where you can just look at
one of the things that is at least theoretically definitely an advantage in a world in which markets are dominated by passive money, particularly in the US. Being in the relevant index potentially, theoretically, might cause a revaluation.
Yeah, it might improve your liquidity and get some of those passive flows. I had this I know we're going on a sidetrack, but I was actually discussing this with the previous president of the CFA Society, Paul Smith, if I'm mistaken. So I said to him, we're outside this event and we're talking. I'm like, all this passive, blah, 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 and they're driving. And you know what? I don't know if it's true or not, but he's like, you know what? We looked at it and you don't need that many smart investors to have the right price. So how much, I haven't looked into it, but, you know, um, he's not that far off. And I think even though people discuss all these flows, 20 years ago, the .com boom and everything that was going on, it was crazy. I think markets are always crazy. I don't think things change as much as people think they do. I think we like to find excuses that markets. I have a book from when I was 15 or something, and it's titled The Dollar Crisis.
Yeah, yeah. If it were written today, crisis would not be spectacular enough. It would have to be the collapse, the end of the US dollar. Then it might sell. In any event, as I said before, I do think that although there's a good chance that IWG shares re-rate in the interim, my suspicion is that the full value only gets realized when these three businesses are separate. But we have digressed slightly, and we were talking about the franchise business. So this conversion, this transition to capital light franchising began in 2019 with the sale of its Japanese business and the franchising of its Japanese business. Now, it has not done a similar deal since 2019, and sometimes it gets criticized for that. But I would point out that the pandemic happened pretty soon after 2019.
On that sale, do you know how much operating profit or cash flow that business was going? Is it disclosed?
No, Japan was lumped into Asia Pacific. So the operating profit for Asia Pacific as a whole in 2017 was 35 million sterling, which was about a bit less than 10% of revenues.
Yeah, it's in the segmental analysis in the annual report of 2019. So they made 34 million for 2019. So we didn't have COVID, so that's normal. That 35 million then.
And you didn't have lease accounting in until 2019 either, so it's cleaner.
Asia Pacific was 340 million of revenue. So 10%. So they paid, what did you say, 3.4 times, right?
Yeah. If it was 10%, then they paid 34 times operating profits.
Okay, so they paid 34 times operating profits.
Yeah.
Hence your discount to 2.5 times revenue.
Yeah.
Okay.
Anyway, back to the managed and franchise business. As I said, they haven't done another deal like that, but I think that's partly because the whole transition was put into a kind of a deep freeze for a while, whilst the future of office was being sorted out, or at least somewhat clarified. And secondly, interest rates rose, and so nobody's thinks that 3.4 times is the right multiple. But they did, particularly post the lockdowns, they have done a lot of smaller deals, and a lot of their openings have been for new buildings, not existing buildings in the traditional business. But somewhere along the way, they hit on an improved version of this capital light business. So the Japanese business, as I said, was reported to leave them with a franchise fee of 4 to 5% the annual revenues. But managing flexible office space is a whole lot different than managing conventional office, where you do effectively one deal with one company, at least per floor, if not per building. In the flexible office space, the leases tend to be pretty short, and you're always trying to find more tenants. You've got billing. You've got the provision of services. The management challenge is a whole lot different. And so IWG, whereas the Japanese business is franchised, most of the growth in this business since then has been what they call managed. This is where, although IWG does not own the building or even lease the building, it does manage the space, and that includes the manning of reception and secretarial and security. It means the sales function. So with the convention with a flexible office space, you've got lots of different rooms within the same floor, within the same building. Many of them will have different tenants. There's always some occupancy which you're trying to fill, and IWG, of course, has been doing that in its conventional business for a long time. So the beauty of the managed business compared to the franchise business, it remains capital light, but IWG reckons that it gets 12 to 15% fee of annual system revenues. A lot of franchise businesses use this phrase, system revenues, which in this case means the rent that the landlord collects, although physically IWG collects it on behalf of the landlord. Billing is one of the things that they do for the landlord. The fee is 12 to 15%. Of course, they have some OPEX then because they've got some people and some additional costs. But it looks like, to me, it's a more attractive business even than straightforward franchising, because you can get a higher margin. Maybe, I mean, if you have a look at hotel businesses, although for example, the franchise fee might be 5%, they have very little, at least variable operating expense, and so the EBIT margin might be 50%. I think that in this business, you get, instead of a 5% franchise fee and a 50% margin, you might get a 12 to 15% management fee and a 30% margin. So you end up with a better result overall. So this is the franchise and managed business. It has been somewhat frustratingly slow to develop because they haven't been able to do deals like Japan, given the uncertainty around the future of office and the rise in interest rates. But they have done a lot of new deals, and as we speak, the total number of office space that they have in the franchised and managed business is 20% of the space that they have in the traditional business. And they have a pipeline, what they call a pipeline, which is another 20%, where the deals have been done, but the centres have not opened yet, and therefore they're not yet generating revenue. They're in the process of converting. In addition, when you open one of these new centres for the first time, it does take. I mean, in the traditional business, it used to take 3 years to fill up on average, to fill up a traditional flexible office building. We think it's faster in the franchise and managed business, but it still takes a while, 18 months, 2 years, for the revenues to reach full capacity. So you have got a business which is growing quite fast, and in terms of the space being managed is now really material.
They don't have to redecorate or anything. Is it just them staffing?
The marketing, and because the selling effort is material in flexible offices. You're, instead of selling a big space to one employer, you're selling potentially lots of individual office rooms to potentially lots of different employers. So the sales and marketing effort is material.
So their benefit is they don't have to commit any capital.
Yes, that's right. I didn't make that clear. The building owner, if this is a conventional office, and the owner of the building wants to convert to a flexible office, then they incur the capex. IWG does not incur any of the capex. So, in fact, somebody was asking me about this the other day. In 2019, growth capex for IWG was 300 million, I think, about 300 million sterling. 300 million sterling. In the first 6 months of 2024, for which they reported, the growth capex was $28 million US. So it's almost down by a factor of 90%. So it's becoming, although you've still got the leases on the balance sheet in the traditional business, it's becoming a much less capital intensive business.
But it seems this managed business doesn't seem to be making money.
The revenues are lagging behind because it takes a while to get a building up to full capacity utilization after you open it. So there's definitely a lag, but the profitability, yes, is it's still a fledgling business in that regard. In the most recent half year, the managed and franchise business generated $287 million of system revenue, that is rents and other payments made by the tenants. IWG's share of that was $35 million, so that's about 12%. That's the 12% management fee. And what they have done so far is to lump in all of the expense with the traditional business. By the way, those numbers look more impressive. There was as you know, this being a UK company, they don't give a full disclosure every quarter, but you do get a trading statement, which includes, essentially whatever information management wants to provide. But at the least, it contains some information about volumes and revenues, if not margins and profits. But in the 3 months to September this year, the contribution from the managed and franchise business had gone up to 23 million on a 3-month basis. So if we were to divide the 6 months in two, for the previous 6 months in two, that's from 17 and a half in a 3-month period to 23 million just in 3 months. So that's 30. That's about a third, isn't it? About a third in 3 months.
But that's before the overhead, because I see.
Yes, that's before overhead.
So including the overhead, then they had overhead of 44. So now with the, what did you say, it was 23 in the
23 in the quarter.
Okay, 23 in the quarter. Then it's their break even on a pre-IFRS adjusted EBITDA basis. Wait, let's just say that again.
But they don't have any leases in the managed and franchise business.
That's true. I don't even know why they put it there. They should just leave that on. Just say adjusted EBITDA.
Yes.
So, yeah, because that's why I said it didn't seem that I was doing too well, because I also saw that even though the system revenue was up 15% in a constant currency for the first half, then there was also their own KPI of RevPAR, which was down 14%. That's why my initial comment was, "Oh, these guys aren't really growing." It's like, plus 15,
Okay.
minus
I
14.
mean,
But you are right. You are right. There has
it's
been
difficult.
an
Yeah. I
improvement.
mean, the good thing is that they're now starting to report like a hotel. And so you do get RevPAR type information now that you never used to get in the past. Because the thing is growing quite fast, the revenue per available room figure is currently quite volatile.
Okay, understood. And that's just in the trading statement, right? So it's not filtered through to the market.
If I mean, we've seen a number of different companies and sectors go through this process of transitioning to capital light, transitioning to franchise. The hotels have done it in a way that software companies have done it in moving from, I mean, not so much capital light, but moving from a one-time upfront software license fee to software as a service. And two things are true. One is that it's kind of difficult, or at least it takes a lot of work, and even then, it's kind of difficult to disaggregate everything that's going on during this transition process, because the revenue numbers are not growing because the franchise and managed segment only generates 12 to 15% of the revenues on an equivalent basis that the traditional business would generate. So that's one problem. And so some of these businesses, they kind of get out of favor during the transition and then only kind of emerge once the transition is substantially complete. But once they do that, I mean, have a look at the multiples that franchised hotel businesses get, and they're 25, 30 times price earnings ratio. And I would argue that fundamentally, the IWG franchise and managed business is higher quality than hotels, for the simple reason that most people who go to hotels stay a small number of nights, and therefore you have to incur more marketing to keep replacing your visitors. In the case of offices, then tenants stay at least, I mean, I think the shortest lease you could get from IWG would be 3 months. It might, many of them will be a lot longer than that. And you pay up front. That's something else. You have to pay your monthly rent up front. So quite good for cash.
No, it makes sense. And
by the way, we didn't talk about this, but one of the reasons that this business is growing, we talked about sort of demand from the companies and also potentially demand from the employees who don't want to go into the central business district offices so much. But very importantly, there's quite a big demand from building owners. Because because they can see the future for conventional office is at best uncertain, and converting to a successful franchised and managed flexible office arrangement ends up giving them more revenue because it's a lot harder work, because instead of leasing a large amount of space to one employer, you have to lease a much smaller amount of space to many employers. So it's harder work, but of course the rents are significantly higher for flexible office space than traditional office space. And most of the, I mean, this is management speak at IWG, so you have to remember that. But they would say that most of their building owners who've converted to flexible, franchised and managed report that they get a higher revenue than from the traditional operation of the office. So these building owners, they're tapping into a growth market. They are somewhat mitigating the risk associated with the future of traditional offices, but they are also generating more revenue per building or per unit space than in the traditional model. So this is another reason why there are growth drivers behind this business.
I guess another way to think about this is I'm just looking here at rooms opened, right? So the conventional, traditional segment has 772,000 rooms, and the new segment has 169,000 rooms. So I'm just
That's right.
thinking, you
That's
know,
about 20% of
yeah,
the.
so I'm thinking, okay, so if that, it would be, let's say, I don't know, times five. Fee revenue was 23. There's also like times five. We'll get maybe 120, something like that.
Yeah.
So, if we have the same sort of cost of what was it, what 44 or
I
something?
mean, I hope it's a lot better than that because, of course, a lot of these buildings are relatively newly opened and therefore they're not operating anywhere near full capacity utilization.
So 23 times 5 minus 22. Maybe you'll need some more workers. That comes out to 93.
And that's for a
Um,
quarter, right?
what's that?
That was for a quarter.
Yeah, that's for a quarter. So then it becomes meaningful
Yeah.
to
Four to
the
$500 million
yeah, yeah,
ought to be doable.
yeah.
And hopefully we're talking about, I mean, it's hard to know at this stage, but maybe it's a 30% margin and post-tax, I don't know, 20, 25, 30 comparable businesses trade at. You
Yeah.
take your choice.
And you're not really affecting the TAM either, because essentially, if you're taking existing buildings and they're well, let's say converted in inverted commas, because
Yeah.
to this managed model, then you don't need. It's not like you need the market to expand. You're just
Yeah.
taking on these buildings under your umbrella. Um,
Yeah. You're converting kind of traditional offices into flexible offices along the way. So,
I guess there's different ways to approach this. Let's assume you're more looking at it like just as a standalone, business. What is your valuation of this?
yeah.
Assuming, not going through the sum of the parts, but more like going like, if I own this entire business, what do I think it's worth based
Yeah.
on its cash generation or its profit generation or whatever?
Yeah. Well, I mean, before I get to that, I would say that, clearly there's quite a lot of uncertainty involved as this business develops and transitions to capital light and maybe work returns to growth and higher profitability. There's an awful lot of uncertainty into what this business is really worth. So my favorite way of valuing it is to use the two private market transactions. The first of which was the November 22 offer by CVC for Worka. Today, that's equivalent to £1.37 a share. And then the February 2021 CB Richard Ellis acquiring 40% of Industrious, which we talked about. If you use just the cash element of $200 million, you get to £4 a share. If you use the 330, which I mentioned, which includes the evaluation of the business that they folded in, then you get to £6 a share. So based upon that, you get from £5.40 to £7.40 based upon those two transactions. One of which was a transaction, the other one was just an offer. And I think if you, to be, I use that because I think it's a reasonably robust valuation for a business which, because it's in transition, is not easy to value. Another way that you might do it is to say that management. I mean, currently they're making about $550 million of EBITDA. So you could put a multiple on that. I don't know. Let's make the maths easy. Let's call it 10. Then you would have $5.5 billion. Call it £4.5 billion. That's about £4.50 a share. Management have said that their medium-term target is $1 billion of EBITDA. So you would only, if you put even a 7 times multiple on that, that would be $7 billion. Call it £5.5 billion sterling. Then you'd be talking about £5.50. Again, huge amounts of uncertainty. I get that in the valuation, but today the market cap is 1.5 billion, and the enterprise value is 2.1 billion sterling. So it's hard for me to do a calculation which doesn't come up with a 3x and upside to 5x.
Mm-hmm. Okay.
And of course, the transition to capital light is throwing off cash, and they have already more or less stated that they'll do a buyback once the debt is the ex-lease debt is 1 times EBITDA. Today it's about 1.5 times EBITDA, but given that the transition is throwing off quite a lot of cash, we're kind of hopeful that they might get to 1 times debt to EBITDA by late next year.
Here's another way that I was thinking about it, is that they said in the first half they had EBITDA pre-IFRS of 274 million.
That's right. Yeah.
So
Dollars.
that's pre-IFRS. So I multiply that by 2. I just annualize it.
Yep.
Get 548. So then I know that they also said that their non-lease depreciation is 220. So then I just annualize that to 440, just doing some back of the envelope calculations here. And I take that off of the EBITDA to get to an EBIT of 108. So that's how I come up with my non-lease EBIT. Does that make sense?
I've never looked at it that way, and I've never looked at it that way because I don't believe I don't believe the depreciation or interest expenses associated with either the right to use asset or the lease liability. So I've always tried to use EBITDA and cash.
Okay.
So I think, for example, the free cash flow before capex, I think it must be £200 million of free cash flow that is before growth capex in the last 6 months, but annualized. And so that, of course, will be after the payment of interest on the financial debt, not the notional interest on the lease liability. So you're paying in market cap terms, you're paying 7 times that on a market cap terms. On a enterprise value, you're paying not much more than 10. But it's not so much the current numbers that that tell you what this thing is worth. It's the breaking out of worker, and it's the conversion from conventional leases to the franchise and managed business.
Oh yeah, I agree 100%. It makes it so much cleaner and easier to understand. Maybe they can find someone else to get rid of the rest of the properties.
Well, I think there is a chance in the sense that for the last three or 4 years, there's been so much uncertainty about the future of the office. Why would anybody want to enter into a major transaction to buy the office space off IWG, like the Japanese real estate company did for the Japan business in 2019. Nobody would want to do that whilst the future of office was so uncertain. I do think it's clarifying somewhat, and therefore there's a chance that they can start to do those rather bigger deals, which speed up the transition and throw off a lot more cash. One other things that I didn't say that maybe I should have done is that one of the reasons I think that the share price has been relatively weak is that there's a very big shareholder who's selling down, and that's Tosca Fund, which used to own, I think, 16% of the stock, something like that, a few years ago. And I think they're having redemption, so they are a forced seller. Certainly, they're down to about 9% of the outstanding shares now. Last time I looked, and I don't know how far they've got to go.
I see where you're going with this. Severely undervalued versus transactions that have occurred. There is the possibility of the managed part taking off, which is not recognized by the market.
One of the reasons I say it's not like WeWork is that it's been around, it's been listed since 2000, so 24 years, and from a cash perspective, it has generated cash pretty consistently. It hasn't always generated profits because of the issue with accounting for leases, but it has consistently generated cash, unlike WeWork. Its growth has been largely self-financed, so the net debt being 1.5 times EBITDA, whereas WeWork, I forget the numbers now, but the amount of debt was hideous. It's a very, very cost-conscious culture and a very cash-focused culture. It has, in the traditional business, all of the properties held within their own SPV. So in a way, you could argue that at least lease by lease, these are unlike any other company's leases, because they're all individual, they're all tied to individual buildings, and IWG could walk away from any of them with no recourse to the rest of the business. They have now got 40% of the lease liabilities where the rent payable to the building owner is linked to revenue. Nobody else has a worker. Nobody else yet is transitioning to a capital light model, and it's 6 times the size of the next biggest competitor. So it's as cheap as it was in the financial crisis when. I mean, we didn't say, but I told you that the U.S. business declared Chapter 11 in 2003 in the .com crash, the .com recession. Well, The UK business also declared bankruptcy in I think in early 2010 after the recession following the global financial crisis, which again, Mark Dixon, he bought it back out of bankruptcy. So the stock is now cheaper than it was in the teeth of the worst two, probably office-related recessions in human history.
Dude, that's not giving me a lot of comfort. You just told me twice that this guy went bankrupt and bought it back on the cheap.
Yes. Well, I told you twice. There's a third time as well. In 2020, in the middle of the lockdowns, they put 75 special purpose vehicles into bankruptcy and walked away from £700 million worth of leases.
Well, that's a positive. That one's a positive.
Yeah. But that's three.
I mean, wait. What happened? So in the other two bankruptcies you mentioned, the shareholders were affected?
So not in one sense. The shares continued trading. In 2003, it was the US business only that went into bankruptcy. And in 2010, it was the UK business only that went into. Because at that stage they had not converted the UK businesses, not completed it anyway, to special purpose vehicles, and so in both cases the cause of the bankruptcy was that in the recession the tenants stopped paying. I exaggerate to make a point, but they paid less. They stopped paying, but without the special purpose vehicles, it was difficult for IWG to persuade building owners to cut the rent that they were paying, and so that was particularly acute in 2003. So to get around that, they declared Chapter 11. But now it wouldn't happen that way, as it didn't in 2020. They just chose the 75 buildings that were had a real problem, and they put those into bankruptcy and walked away from the leases.
So what's the downside case?
Well, probably the real downside case is that nobody ever notices what's going on, and therefore the shares don't move at all. In fact, if Tosca Fund keeps selling, they might go down some more, and nobody ever notices. I just can't come up with any way in which the intrinsic value is not multiples of the current share price. Quite how that crystallizes, I don't know. I think the plan is that 3 years from now, Worker will have grown to a significantly bigger business, and they will sell it. And 3 to 5 years from now, the franchise and managed business will be the majority of the business, either through a kind of natural organic transition, or that they manage to sell out the leases on the traditional business in the conversion to franchised and managed, and so the traditional business effectively gets sold as well, so that it becomes purely a franchised and managed business, having thrown off an awful lot of cash through the conversion of the company owned and leased, and the sale of Worker.
So there's a lot more we can talk about. It's not a simple case. Simon was very kind to come up and make things a little clearer here. Tell us about this founder operator who's trying to maximize value now for shareholders through this moving to this asset light model, which seems to be starting to make some money now. So there's a lot of potential upside from that, or the other lever being it being revalued to where there were potential deals or an actual deal really happening. So it looks like there's some weakness because of the selling going on from some shareholders, and just because the whole space is negatively considered. So I've had an education here. I'd like to thank Simon. Anyone wants to reach out to Simon? I think you're on LinkedIn.
Yeah, that's just about the only way you can do it, but I'm happy to do that.
So as a reminder, Simon is a business owner who turned a private investor and spends his time looking at value stocks and chatting with guys like me.
Well, so thank you, Sophocles. An absolute delight, as always, to talk to you, and I wish people good luck with getting to grips with IWG.
All right,
or not, if that's their preference. That's okay too.
Thanks, Simon. The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.